Good afternoon, and welcome to this week's SCORE webinar. My name is Steve Smith, and I'm a business counselor here at SCORE in Fairfield County. Today's webinar is entitled, and content will be all about financing your small business or startup enterprise. And again, our presenter will be Cliff Ennico. Some of you have heard Cliff in the past, and I'll give you more of an introduction to Cliff in just a minute. But first, let's just talk a little bit about SCORE. Some of you already know this, some of you don't. SCORE is a part of the U.S. Government Small Business Administration and was started in the mid-'60s. I think right now we have in excess of 300 offices around the country, maybe 320, 325, and 11,000 plus volunteers. In SCORE Fairfield County, we've got over 100 volunteers with various industry, process, and subject matter expertise. We offer workshop programs, live workshop programs, usually held in local libraries or other such venues around Fairfield County. Also, we have this webinar program, which some of you have been ardent supporters of in the past, and that's on the first and third Tuesday of every month. And of course, we do one-on-one counseling and mentoring in our office on East Avenue in Norwalk, Connecticut. Any of those programs that you'd like to participate in addition to the webinar, which you're obviously participating in now, you can find the way to get individual counseling or the workshop schedule on fairfieldcounty.score.org. Fairfield County, one word, no caps, fairfieldcounty.score.org. And our next webinar is going to be in 2 weeks, July 25th. And the subject of that webinar will be optimizing your website to maximize lead generation and sales. So again, you'll find the specifics of that on fairfieldcounty.score.org, and you'll be getting 2 email reminders in advance, one about 3 weeks in advance and one 2 days in advance. Today's webinar will end sharply at 1 o'clock. It's being recorded. And the link to the recording with the slides will be available, again, you're going to get tired of hearing this, fairfieldcounty.score.org, and they should be there later today. Now, as usual, we've set aside time for Q&A at the end of Cliff's presentation. If you have a question, please use the chat window, which is in the bottom of the left-hand at the bottom of the left-hand part of your screen there. You'll see, and I've been told that you haven't been able to hear me very well. So I'm trying to get that fixed right now. Hopefully it's improved. If anybody down in the chat window could let me know, that would be good. So there is an audio problem. Some are hearing it, and some are not. Okay, Amy, thank you. Peter Van, okay, thank you. Okay, so most of you are hearing. So, all right, let's keep going. Good. Again, Q&A at the end of the presentation, probably last 10 or 15 minutes. Enter your questions in the chat room, then the lower left hand. I'll administer that chat room when we get to that point in the program. At the end of the webinar, you will be receiving an email from SCORE asking you to evaluate the quality of the webinar. And thank you very much for doing that. We do appreciate and use your input. Now, on to our speaker, Cliff Ennico. Cliff is a very big friend of SCORE Fairfield County. He participates in workshops and in our webinar program, but he's probably best known as a former host of Money Hunt, a fast-paced PBS reality television series. So he was into reality television before the current residents at 1600 Pennsylvania Avenue. His weekly business advice column called Succeeding in Your Business is syndicated nationally. He's an attorney and small business consultant based in Fairfield, Connecticut, and he's helped launch over 15,000 businesses. He's the author of 16 books. He's a busy boy, isn't he? Most recently, the Crowdfunding Handbook, How to Raise Capital for Your Business Using Equity Funding Portals. I'm sure some of that will be in today's presentation, so I'm going to turn it now over to Cliff, and I'll be back to you at the end of this presentation. Cliff?
Hey, thanks, Steve. Thanks very much. I think the volume now, I think I've just blown out about 15 people's eardrums because most of my clients tell me that I don't need a telephone, much less a microphone to get news across. If you are having trouble hearing me, please go to the send a chat message because I'm looking at that right now, and then I'll really get loud. Okay, this is obviously one of the key topics when starting any kind of a small business or a technology venture, startup venture of any kind. Where's money going to come from? And I want to begin on a little bit of a down note, but I promise I'm not going to stay there. In my experience, I've been working with small businesses now for 37 years of my life, and in my opinion, there are three main reasons why small businesses fail. The first two we're not going to talk about, but the third we will. The first is the market just isn't there. You thought the customers would be there, but for some reason or another, they're just not buying. They don't behave the way you think they're going to behave. That's one. Number two, the market's there, but there's so much competition you simply can't deal with it. There's no room for a new entry into the marketplace. That's number two. Number three is, and this is the biggest one really, underestimating your startup capital. Not having enough money to get up and running and get through the critical first 6, 12, 18 months of operation. I can't tell you how many businesses I see fail, even with good financial planning, who just didn't understand how long it was going to take for them to get that first sale and to break even. Money is critical, and if you don't have the money yourself, if you are not a reality TV billionaire, you have to find this from somewhere else. And we're going to talk about that a little bit later, how we do it. But first of all, we must give our disclaimers here. And let's see. There we go. Now you know that I am a lawyer. We do these on every program. Obviously, while I do have a very close relationship with SCORE, I am not a SCORE counselor, employee, anything like that. So if you take my advice on this program and you end up going bankrupt and living in a diaper box under the Brooklyn Bridge, you can't blame SCORE, and also you can't blame me either. But the more important one here is the second one. We are going to get into some legal and tax stuff on this program, and while I'm perfectly happy to give some general information, that's a lot different than giving one-on-one advice. There's a big difference between here's what the law says and here is what you should do. Obviously, I'm not in a position to do that on this, the latter on this call. So seriously, if you do want me to speak to your situation specifically, you can always call me, and I'll be happy to give you, the best answers I can for a very small and reasonable fee. But I'm not going to be able to do that on this program. So that's it. We're going to be doing this in two parts today. I really wrestled with how to present this information without getting into a lot of accounting and a lot of numbers, which scares some people. So we're going to do this in two parts. The first part of this program, I want to talk about how a small business is capitalized, what we call the capital structure or the cap table, and what that looks like and how you put that together. One point I want to make, most startup ventures and small businesses are organized either as corporations or LLCs, or subchapter S corporations. The terminology is a little different when you're dealing with corporations versus LLCs, and I'm not going to get into that on this program. So, for example, the owner of a corporation is known as a stockholder or shareholder. The owner of an LLC is called a member. I'd rather not get into a lot of that because it's going to confuse people. Some of you have corporations, some of you have LLCs. So I'm just going to use the same terminology for both. So when I refer to shares or stock, if those of you who have an LLC, just translate that into membership interest, because that's the technical term for the owners of an LLC. I'd rather not confuse you. The concepts are important, and I want to not get caught in the weeds, because some people have corporations and some have LLCs. Okay, so let's begin. First of all, a very basic concept here that I want to get across. And whether you have a corporation or an LLC, the same rules apply. There are two ways, and only two, that you can put money into a company of any kind. You either do it as debt or as you do it as equity. And there's a huge, huge difference between the two. If you are making a loan to the company, you get repaid over time with interest. You must charge interest on a loan, even if it's just a loan to your company. A lot of people say, well, I make loans to the company, but it's 0% interest. You can't do that. The IRS doesn't buy that. There is a minimum interest rate. It's called the AFR, stands for applicable federal rate, but basically it's the lowest interest rate that a loan can be made. Right now, currently, as we're doing this program, it's about 3.5% per annum. If you are doing a loan to the company and you don't charge interest, the IRS comes along and they will impute interest at the AFR rate. And you will have to pay income tax on that because, as you know, when you loan money to anybody and they pay you interest, you pay taxes on the income, on the interest income. So whenever you do a loan, even if it's a loan to the company, find out what the AFR is. You can look it up online. Very easy. It's on the Treasury Department website, and you can you make sure you charge interest, the same as you would if you were loaning money to me. You know, if you were, you would definitely charge interest if you were doing that. Okay, debt holders get their interest back. They also get out first. If you think of a small business as the Titanic, which, by the way, is a very useful metaphor for 90% of the small businesses that I deal with. The Titanic's a perfect metaphor. The debt holders are the ones with the best lifeboats. These are the first-class passengers. If the Titanic hits the iceberg and goes down, these are the people who will probably get away with their skin intact, is the best way to look at it. They are at the top of the heap when it comes to a company's capital structure. The first thing a company does when it goes under, it pays off its debts. So by making a loan to the company, you are at the top of the heap, and you will get out in time, and you will also get your interest too, your accrued interest, if there's enough money to pay that. The bad news is you don't really technically have the right to manage a startup business. You know, if you have a loan from a bank for your business, the bank can't tell you what to do. The only right they have is the right to get their money back on time. If you fail to make your monthly payment, you're in default, and they'll seize your assets. But they can't tell you you really made a bad decision there. You shouldn't have acquired that company. You shouldn't have hired that guy. They can't do that to you. A debt holder just sits back and gets his money back with interest. Now, it can be secured by the company's assets, and when I form companies, I recommend that the founders do this. We'll talk about founders' loans and founders' shares in a bit. But debt, that's debt. The thing is here, you're trading off one thing for another. The good news is you get out first if something bad happens. The bad news is if the company takes off and becomes the next Facebook or Twitter, you don't participate in the upside. You don't. All you get is your what they call your coupon, your 3, 4, 5% interest, whatever you're charging. Now, equity is different. Equity is not a loan. In equity, you put your money into a company, and in exchange for that, you receive a percentage of the future profits and losses of the company, what we call shares. You are an owner of the company when you make a capital contribution. In a corporation, it's called stock or shares. In an LLC, it's called membership interest. Like I said before, I'm only going to use the term shares or stock because I think it's easier to get through the program. In an LLC, there's a further distinction, which we're going to talk about later because it confuses a lot of people, between a capital interest and a profits interest if you're an owner. It can be voting or non-voting. Most companies have a class of voting and a class of non-voting. A lot of tech ventures do that. But you also have, here's the key, the equity owners have the right to manage the business. These are, going back to my Titanic example, these are the people in steerage. That's who equity is. They may not get out with their skins intact if the Titanic hits an iceberg, but unlike the Titanic, they are the ones driving the ship. They're the captain and the crew, which, historically they are the last ones off the ship, at least they're supposed to be. This is it. They're the ones that drive the bus in general. The trade-off here is that they are at the bottom of the cap table. They're at the bottom of the capital structure. They do not always get their money out if the company goes under, but in exchange for that, they have the right to make the decisions. The debt holders don't. That's the basic decision between debt and equity, and it's either one or the other, folks. You cannot fudge this. One of the big problems I have when people are starting a company is they do these things that make it very unclear to me whether something is debt or something is equity. and that is a problem. It has to be one or the other, and if you're working with me, I'm going to want that very, very precise in your organization documents. Okay. Let's talk about putting money into a company. As I said before, there are two ways. The founders either make loans to the company and be repaid with interest, or they make capital contributions to the company and they get founders' shares. Now, you can get both. In fact, you should get both. Okay. When I form a company, what I normally do is I form the company with as little capital as possible, and here's why I do that. Seriously, $100, from everybody. If the founders here's the difference. If you are a founder of a company and you make loans to the company, the loans can be made any way you want to. The founders do not have to put in the same amount of money. It can be all over the place. If the founders make capital contributions, however, they must be pro rata. Right? Pro rata means based on their ownership position. So if Steve and I, for example, were to set up an antique store, and we're 60-40, let's say. Steve is 60 because he's the guy who's going to be doing the work. I'm just the guy who's sourcing the antiques, whatever, on eBay. We're splitting up, and the company needs $1,000 worth of capital. He must put in $600, and I must put in $400. If we do it any differently, it changes what we call the capital account, or the owner's equity of the account of the company, and over time it changes our percentage ownership. So if I'm putting in more money than Steve as capital on a regular basis, then sooner or later we're not going to be 60-40 anymore. We're going to be closer to 55-45 and eventually 50-50. That's how the tax laws work. So whenever you're putting money into a company as a capital contribution, it must be pro rata. Loans, on the other hand, can be all over the place. If Steve and I are loaning money to the company, we can put in whatever we want, when we want, and it doesn't change our ownership percentage. We're still always going to be 60-40 because that's what we agreed on. So when I form a company, I form it with as little capital as possible. Everything else the founders put in the form of loans, and we use something called a grid promissory note for that. And I'll talk about grid notes a little bit later on in the program. It's like a private line of credit. Now let's talk about taking money out of a company. Steve and I have our antique store. We're 60-40. There are only two ways we can put our money in. We're loaning money to the company. Every once in a while we'll do a capital contribution. But taking money out, we have three options. The founders can either receive compensation. I said before that Steve is the worker guy. He's in the store 7 days a week selling antiques. We may have a deal, between us that, after we pay our operating expenses each month, the first $2,000 we make, it goes to him as compensation for his time. He's putting in $2,000 a week. That's compensation. Technically, with an LLC, you don't call it compensation. You call it a guaranteed payment. But wink, wink, nod, nod. It's exactly the same thing. You can receive money for your labor. In fact, with an LLC or an S Corp, you want to pay your owners as compensation as much as possible because that's deductible to the company. Other things are not. So that's one way. You can pay yourself compensation for your labor. The second way is you can, if you've loaned money to the company, you can pay it back. Principal with interest. Remember, you have to charge interest on loans. You cannot have an interest-free loan, at least not under the tax laws. You cannot. So you can pay back the loans, reduce the debt burden on the company. If the founders have put in $100,000, that's a very heavy, in the form of loans, that's a very heavy debt load. You want to pay that off over time. So that's another way. Last but not least, you can receive periodic dividends or distributions. It's called dividends of the corporation, distributions for an LLC. As a return on their investment. This is a distribution of profit, and it is not deductible to the company. That's the thing. You cannot deduct dividends. You cannot deduct distributions of profit. You can deduct compensation to your workers, but you cannot deduct distributions to your shareholders, even if they're the same people, even if they're the same human beings. So you want to pay back, just like you want to put in the money as much as possible as loans. Taking it out, you want to do it as much as possible as compensation or some way other than distributions. Distributions are not always good. Okay, if you are paying compensation to one of the owners, this should be clearly spelled out either in the shareholders or operating agreement or by a resolution. Always make sure that's in writing. Loans should be documented by promissory notes. Distributions, the thing you got to remember, just like when you're putting money into a company, capital contributions must be made pro rata. When you're paying money to your owners. Compensation is deductible to the company. Loans are partially deductible to the company, but distributions must be made pro rata. Just like contributions of capital, distributions have to be pro rata. If you are making a distribution of profit, and Steve and I are 60-40, if we have $1,000 and we want to pay it out as a distribution, Steve has to get $600, I got to get $400, or else again, it changes our capital account, our owner's equity account, and our percentages are going to change over time. Distributions must be pro rata. Compensation loans, you can do it any way you want. You can agree to pay off one founder's loan but not the other. You can pay one person compensation, but the other person gets nothing. You can do that. With distributions, though, it always has to be based on percentage ownership. Another little rule, and this is a rule strictly for corporations, dividends can only be paid out of profits or surpluses. If you have a corporation and your company is not yet showing a profit, you cannot technically pay dividends to your shareholders, although you can pay compensation or repay loans. Okay, so let's take a look at what we call a cap table. When you start a company, and especially now I'm heading more toward tech ventures. Let's forget our little antique store. Now we're going to be doing a tech venture. We're going to do a smartphone app or something like that where we expect to get investors. People are not going to invest in an antiques business, but they are going to invest in a manufacturing or technology company. One of your first challenges is you have to put together what's called a capitalization table, or as we call it for short, a cap table. This is simply a list of the owners of the company, how many shares they have, and what percentage of the ownership it represents. That's what a cap table is. It's just a list of people and how many shares each one has. And you include people who own options and warrants. We'll talk about those a little bit. Here's how a typical cap table looks. We read it from top to bottom. At the very top, we have the loans to the founders. Cliff and Steve put in $50,000 each, and we're getting that back with 3.5% interest. We have promissory notes for those. That goes at the very top. Debt always goes to the top because, like the Titanic, these are the people who get out first when the ship hits the iceberg. Below that, we have equity, and we have, in this particular company, and this is very typical for tech startups, we have three classes of equity. At the top of the table, we have classes of preferred equity, preferred stock in a corporation, preferred membership interest in an LLC. These people get their money out before anyone else if the company goes belly up. If you own preferred stock, you have what's called a liquidation preference. If the company goes belly up, and after the debt has been paid off, debt holders always get paid off first, you get your investment back plus any accrued interest or accrued dividends that have happened and that have not been paid. You get that before the common shareholders get anything at all. There are no rules regarding preferred equity. It's a contract. If I'm looking to invest in your company and I'm going to take preferred stock, we negotiate the terms and conditions on an individual basis. And in the second half of this program, I'll talk about some of the things you can negotiate. That's preferred stock. Now, not all companies have preferred stock, but in a tech company, it's very common. This is how your angel investors will want their investment to look. They will either be looking at convertible notes or preferred stock. Below the preferred stockholders, we have common stock. Common stock, again, this is equity. These are the people who are driving the bus, and in exchange, they're subordinating themselves to the debt holders and the preferred stockholders. They're the third level down. And in this company, we have two classes. We have voting and we have non-voting. The voting common is for the founders and the cash investors, people who are putting money into the company. But it's also a good idea to have a class of non-voting common stock. And this is for employees and consultants. These are for people who are putting in what we call sweat equity. We're going to spend a lot of time in the second half of this program talking about sweat equity. If a person puts in labor in exchange for shares, that has tax consequences, and we'll talk about those in a little bit. If you have an LLC and you've got sweat equity people, consultants, whatever, who are helping you develop the smartphone app, you absolutely have to make sure that they get profits interests. and I'll explain to those. Remember, in an LLC, you can have capital interests and profits interests. That's a complicated topic, but we are going to discuss it in a few minutes. You can also give people rights to acquire equity in the future, and this is done by means of options, warrants, and convertible securities, which we will discuss more in detail in a few minutes. Let's go down the cap table now and talk about each of these different players. Let's talk about the debt holders first, the people who've made loans to the company. When you make a loan to a company, it's common to use what's called a grid promissory note. This is like a private credit card or a line of credit. The shareholder agrees to make loans. The founder agrees to make loans over a period of time at a certain interest rate. And as loans are made and repayments are made, it's recorded on a grid, a little spreadsheet, which is attached to the note. On thus and such a day, Cliff Ennico loaned $50,000 to the company at 3.5% interest, and everybody puts their initials next to it. Then next month, if you pay back $10,000 of that, that's repayment $10,000. So much of that is interest, so much of that is principal and initials. That's how you do it. It's a running record of loans and repayments, just like a credit card. Look at your credit card statement each month, and you have a very good idea. Or maybe your bank statement's probably a better. Look at your checking account statement where you deposit money and then you take it out. That's a very good idea what a grid looks like. It looks exactly like a checking account statement. Now, keep in mind that if you do make loans to your company and an investor comes along, he's not going to like that. He's not going to like the fact that one of the founders is going to have a lifeboat that's ahead of his. He wants to have the type lifeboat. Keep in mind that if an investor comes in and there's shareholder debt, he's probably going to want you to either repay that or convert those loans into equity so that he can get to the first lifeboat if the Titanic hits the iceberg. He doesn't want the founders getting away and he goes down with the ship. He doesn't want that. Okay, he or she. Okay, let's talk about that preferred equity, preferred stock. Okay, this is what investors like to see. If you're dealing with an angel investor at some point, they probably will want to see preferred stock. That's what they want to see. If it's a corporation, it must be authorized in the certificate of incorporation. If you do issue preferred stock to a shareholder and you have a corporation, you must put that in the certificate of incorporation. If you have an LLC, it's a little bit easier. You can just put it in the operating agreement. You don't have to put it in your articles of organization, which is a matter of public record. Keep in mind, if you have an S corporation, you cannot issue preferred stock. That is one of the little icky rules of a subchapter S corporation. A subchapter S corporation can only have one class of stock. It cannot have multiple classes of stock. There's a little rule that says that if you have one class of shares and the board decides to issue some as voting and some as non-voting, that's okay, but you cannot have two separate classes of stock. So preferred stock is absolutely out. So how do you negotiate? Preferred stock is a negotiation. It's not the corporation laws, the LLC statutes don't say anything at all about how you do preferred equity. It's entirely up to you and your investor to negotiate that each time it happens. I use this horrible acronym called CC Rebel. It doesn't mean anything. It's just an acronym. Preferred stock can be cumulative, so it can bear dividend. You can actually specify that the holders of preferred stock will get dividends at times. If the company can't pay it, they accrue or accumulate. They can be convertible into common equity. They can also be exchangeable into debt. They can be redeemable into cash, at some point. They can be what's called participating preferred. This means that when the common get dividends, the preferred stock gets to get a piece of that too, based on their percentage ownership pro rata. And then the most important thing in preferred stock is the liquidation preference. If the Titanic goes down, once all the debts of the company have been paid, the preferred stockholders get the lifeboat and get their money back before the common equity gets anything. That's in almost every preferred stock deal. The other things are more negotiable, and sometimes you do them, sometimes you don't. Let's talk about LLCs just for a minute. The difference is in a corporation, if you're doing one or more classes of preferred stock, that must be in the certificate of incorporation. If you have an LLC and you're doing preferred equity, it's in the operating agreement. It can be voting or non-voting. The one provision that I always put in my operating agreements, I always put a provision in my operating agreement that says that the managers of the company can convert the LLC into a corporation without having to go to the members for approval. If you have that kind of a provision in your operating agreement, you should have it say specifically that if there is preferred equity in the LLC and you convert into a corporation, then they will get the same number of shares of preferred stock in exchange for their LLC preferred equity. Or in some cases, if I really have an aggressive board that wants to cram down their investors, I will put a provision in there saying that upon the conversion to a corporation, any preferred equity automatically gets converted into common stock on a one share for one share basis. Let's call it a cram down provision, and you sometimes see it in operating agreements. Let's talk now. Now let's go down to the next level below. Let's talk about common shares. These are the people. First of all, who owns the company? When you're looking at equity, who owns 100% of the company? The answer is the preferred stockholders plus the common stockholders. The two together constitute equity. The debt holders are not included as owners of the company. Even though they may be some of the same people that own the common equity, their loans do not count. Only the equity is deemed to be the owners of the company, not the debt holders. Okay. If you have a corporation, you document your equity as shares of stock in a corporation. In a limited LLC, though, you can do the same thing. In an LLC, you usually have what are called percentage ownership interests or membership interests, but you can, in the operating agreement, specify units of membership interest. So if we have an LLC, you can either say I have 10% ownership interest or I have 10,000 units of membership interest, wink, wink, which function exactly like shares of stock. If you are doing a tech venture of any kind, you probably will want to do this. Investors don't really get percentage interests. Also, it's a lot cooler to get 10,000 shares of units of membership interest than it is to get 0.000486% of the outstanding equity. It's just easier. The math gets a lot easier when you're dealing with shares of stock. So when I do LLCs for tech ventures, not antique stores like what Steve and I were doing, I always want to have units of membership interest that function the same as shares of stock. It'll make life easier with your investors. Common shareholders have rights. Because they get to drive the bus, they have certain rights, and this is to some extent negotiable, but a lot of this is specified in the corporation statutes. And if you have an LLC, LLCs are a lot more flexible than corporations in general. You can do more things in the agreements than you can with corporations. In a corporation, you have to do things the way the statutes tell you to do them. With an LLC, the statute just says, well, whatever you want to put in the operating agreement, great. If there's no provision, here's what happens. So, for example, common shareholders normally have the right to appoint the directors or the managers of an LLC. You can have both voting and non-voting, shares. You can limit their voting rights in some ways. You can say, for example, and this is very common in tech ventures, that normally a majority of the shareholders can vote for things, except for these 5 things, you have to have a 90% vote. We call that a supermajority voting interest. You can do that. In fact, it's very highly recommended, by the way, for tech ventures. You can have anti-dilution protections. If I buy shares at $10 a share, and then 5 months later you issue shares to somebody else for $5, I can get the benefit of that, and I can have my number of shares adjusted to reflect the fact that you're having what's called a down round. Preemptive rights. This means that if I have 10% of your company and you issue shares to somebody else, I get the right to buy more shares at the same price to keep my percentage ownership at 10% if I want to do that. Tag-along and drag-along rights, you'll see these in a lot of tech venture agreements. This has to do when the company is sold. If the company is sold, and let's say, for example, that let's just use the Three Stooges. There's a federal statute that whenever you're in a situation like this, you must use the Three Stooges. Moe, Larry, and Curly own a company. Moe and Larry own 80%. Curly owns 20%. Moe and Larry find somebody at a tech conference. They want to sell the company to this guy. Curly's not wild about it. In a tag-along situation, Mo and Larry can sell their shares, and they can offer Curly the opportunity to sell his shares to the third party for the same price per share. In a drag-along situation, Mo and Larry can sell their shares to the third party, and they can force Curly to sell his shares at the same price. Very often, somebody buying a company doesn't want minority shareholders around. He wants 100% of the stock. So if 80% of the shareholders want to sell, but the other 20% don't want to sell, a drag-along provision is an extremely useful thing to have. I always put that in my shareholders agreements for tech companies. Okay, now let's talk about LLCs. I don't want to go through this in detail because we're going to cover it a lot in the second half of the program. We talked about this before. When you have an LLC, you're going to have two kinds of investors. There are people who pay cash for their membership interest, for their owners, for their shares, and there are others who contribute what's called sweat equity, employees, consultants, those kind of people. They don't pay cash for their shares. When a company has a value, the sweat equity creates a problem for LLCs and for S-Corps too. Not so much for C corporations, but for LLCs and S-Corps, you have a major problem. When a corporation, and the best way to illustrate it, here's a very homely example for all of you. Let's say that you hire me to come over and mow your lawn, and I mow your lawn and you pay me $50 cash. I have to report that $50 in cash to the IRS and pay taxes on it every year, right? It's compensation, right? I'm a lawn mower, I'm a lawn care guy, right? Now, let's say that I come over one day and I mow your lawn, and instead of paying me in cash, you give me a share of stock that's worth $50 on the market at that point. The IRS, and I keep the share of stock. I don't sell it to anybody. I just keep it in my drawer of my desk. The IRS does not distinguish between that and cash. I have to report the $50 in stock that you gave me, and I have to pay taxes on it. Now, the difference, obviously, is that in the first case, when you paid me cash, I have cash money to pay the taxes with. When you gave me the share of stock, I don't. I either have to come up with the cash from some other place, or I have to sell the stock and get the cash. The IRS does not accept tax payments in the form of stock. You must pay in cash. Okay? This is the problem, and it's actually a problem created under the Internal Revenue Code at Section 409A. If you have a company that's worth $1 million and you give 10% to somebody who's providing services, they're not paying cash for the 10%, that person now has a $100,000 tax liability to the IRS, and they're going to have to come up with the money to pay the taxes, even though you only gave them a piece of paper. You didn't give them actual cash money. This is what we call the Section 409A problem. And it's one we're going to discuss a little bit more in detail in the second half of the program. The way you get around this problem is to issue profits interests in the company. So let's say you do have a key player coming on board. Let's say you have a software developer who doesn't want to be an owner of he wants to be an owner of the company, but he doesn't have any money. You got to pay him. He's willing to work for his shares. What happens is you value the company at the time you issue the shares to him, and he only gets taxed on the increase in value from that point on. He doesn't get so. For example, in my example, you have a company worth $1 million. You give 10% of the company to a sweat equity person as a profits interest. Okay, that person does not get taxed on $100,000. That person gets taxed on any increase in the value of the company going forward. So if a year from now the company is worth $2 million as opposed to $1 million, well, then he would have a tax liability of $100,000 on the gain from year one to year two. Gets a little complicated. I'll give you another example of this later on. It's a difficult concept, but it's very important to understand when you have LLCs. Okay. I wrestled with these slides. Some people got what I said in the last 15, 20 minutes, but if you didn't, don't panic, because I'm going to do it again, but I'm going to do it in a different way. Instead of talking now about a cap table where we go from the top to the bottom, let's now talk about a startup venture, and step by step, what happens each step is the way as the company grows. How do you capitalize the company going forward? So there are 5 steps in the capital raising process First, the founders put in their startup capital and they get founders' shares. Second, you plan for additional founders and sweat equity players, such as employees and consultants. Step 3, there's usually a friends and family round where friends and family members get to buy shares in the company. Step 4 is offering shares to angel investors. These are wealthy individuals who invest in startup ventures. Step 5, if you're lucky enough to get this far, you may find that you're actually doing a round of venture capital. And then last but not least, if you really are successful, if you hit the ball out of the park, you will do an IPA called initial public offering, an IPO. Let's take each of these steps in turn. Let's talk about step 1, the founder's shares. People refer to founder's shares all the time, but technically they don't exist. The idea is they call them founder's shares because at the time the founders put their money into the company has no value. Okay, so let's take an example. Let's say Mo, Larry, and Curly. I always default to the Three Stooges. Because quite frankly, if you've ever represented a startup company as a lawyer, most of your clients behave like the characters in a Three Stooges short. That is the reason. We always use the Three Stooges because if you've ever, seriously, I never thought that the Three Stooges were reality until I started representing entrepreneurial companies. Seriously, if you are planning to work with entrepreneurs for a living and be advisors, watch all the Three Stooges shorts. This is how your clients are going to behave. So let's get started here. Mo, Larry, and Curly are forming a tech company. They're going to do a smartphone app. Okay, Mo and Larry have money to put into the company, but Curly is going to put in sweat equity. Curly doesn't have any money at all. Now, if we allow Mo and Larry to put their money in as cash, and Curly doesn't put in anything, Curly has a potentially huge tax liability coming up because of that Section 409A problem that I talked about a few minutes ago. So if Mo puts $50,000 in, Larry puts $50,000 in, Curly is putting in his services. His services, the IRS will value those at $50,000, and he's going to have a $50,000 tax liability at the end of the year, if they're equal partners, of course. I'm assuming that they're a third, a third, a third. If it's 40, 40, 20, then it's a little bit different, but it's still a problem here. Curly's going to have a huge tax liability because cash in a capital system, labor in a capitalist system has no value. Curly is the classic example of a sweat equity player. So here's my example. Mo and Larry have money. They're contributing $100,000 each in cash to the corporation. Curly is the brains of the outfit. He's going to work 100 hours a week, live on Red Bull to develop the product. Curly is a sweat equity player. Okay, basically, this is the classic Section 409A problem. Because Curly is not putting in a capitalist system, cash has a fixed value, but labor has no value. Why? Because the value of services is indeterminate. It's based on market factors, workers' ability to bargain. Show me 5 identical factories producing the same product or service, and I will show you workers who receive very different compensation based on things that have nothing to do with what the company does. That's just general economic theory, by the way. I'm not getting into capitalism versus socialism. We don't get political on these programs. But one of the arguments that socialists make is that that's an unfair system, that labor should be valued the same way that cash does. In a capitalist system, only money has value. Labor does not. My source for that is David Ricardo, one of the very earliest economic philosophers from the early 1800s who did this. If you assign a value to sweat equity, it's taxable income, and it gets taxed at ordinary income rates, which is the highest rate. So the solution to the problem here is we use grid notes. Rather than Mo and Larry putting $100,000 into the company, Mo, Larry, and Curly would each contribute $100 to the capital of the company. So that would make them equal shareholders, a third, a third, a third. But in addition, Mo and Larry would loan the other $99,000 each. Then the math isn't wrong there, but you get the idea. By the way, there are no materials here. I apologize. I took this from another program. There is no form for a grid note, but if you want, you can send me an email. I'll be happy to send you one. It's a very standard form. You can get a lot of forms for these online. But Mo and Larry would sign those grid promissory notes, and they would get paid back over time. Because the loans are not capital, Curly has no adverse tax consequence. We've done away with that. Traditionally, grid promissory notes are payable over 5 to 7 years. And then at the end of that, if they haven't been paid off in full, they either roll over for another 5 to 7 years, or they convert into stock at the whatever the then current value of the company is. So Mo, Larry, and Curly have formed their company. We solved Curly's tax problem. Now, a year later, the app has been developed. Curly did his job. This thing is a big hit. It's selling on iTunes left and right. Now the company is worth $1 million, and Shemp comes along. Shemp is a brilliant software marketing expert. He wants to join the company, but and Mo, Larry, and Curly want to bring him on board, but he has no money. Mo, Larry, and Curly want to give him 10% of the company on top of whatever he's getting, but Shemp does not want to pay taxes on $100,000. And Mo, Larry, and Curly do not want to pay his tax liability. By the way, you can always agree. It's called a gross-up provision, where the company can agree to reimburse a shareholder for his tax liability based on his on any we call it phantom income. He has to pay taxes on income that he never actually saw cash money for. That's called phantom income. A company can agree to reimburse that, but of course that all is based on the company's ability to pay it. If the company's not performing well, if it's failing, they're not going to be able to make that payment. So it's called a gross-up provision. Sometimes I put it in my agreement, sometimes I don't, but you can do that. In this case, Mo, Larry, and Curly do not want to do that. So what do we do for Shemp? Okay, there are a number of options available to us. We can do restricted stock, which can either vest over time or it can be issued all at once. We can do options or warrants with the vesting schedule. Believe it or not, there is technically no difference between options and warrants. The difference is a matter of history. Historically, you gave options to your employees and you gave warrants to your investors. That was the difference. Options and warrants are economically exactly the same thing. You can set up a phantom stock plan for Shemp, or we can do a cash payment on what we call a cash payment if the company changes hands. This used to be called a strip right years ago. I haven't heard that term used lately, though. If you Google it, you might get anything. I'm not going to spend a lot of time on this. I think I have a little too much information here. You can look at the slides more at your detail online. Basically, in a restricted stock plan, Shemp gets actual shares in the company that are given to him over time. He is taxed on the fair market value each time he gets a grant, although since it's being done over time, the tax hit is a much lower tax hit each time he gets shares. There is something called a Section 83B election that Shemp can do, where he can pay all the taxes up front on the current 10% without having to pay taxes on 10% of the company's value each time he gets a grant. He can do that, but you must elect to do it within 30 days of the date of grant. That's a very strict rule. If you don't do that, you can't do the Section 83B option. That's obviously not going to work for Shemp, so we're going to think about options or warrants here. Now, stock option, basically what you're doing is you're promising him to issue shares in the future based on today's valuation. So if the shares are worth $10 today and his options vest a year from now when the companies are worth $30, he has a benefit which is equal to $20 a share on those options. He can exercise his options, get actual shares, and he's only paying $10 for shares that are worth $30. That's how stock options and warrants work. Options and warrants work exactly the same way economically. The advantage is the tax liability is spread out over several years. There's something called a cashless exercise that you can use where he swaps some of his options to pay the exercise price, so he never actually pays for his shares. Whatever shares he nets out at, he gets free. The disadvantage is that it's phased in over a period of time, and as long as he has only options, he doesn't have any voting, management, or other shareholder rights until the options and warrants are exercised. You also got to watch your taxes here. There are two kinds of options, incentive and non-qualified, and they get taxed at different times. That's an advanced topic which is a little beyond our program today. Next, we have the phantom stock or stock appreciation right plan. I'm not going to talk a lot about this. Basically, though, there's no stock here. What you do is you create a book entry. The employee or the consultant gets the book entry, and as the company improves in value, increases in value, he gets cash payments over time. He never actually owns equity in the company. He has no voting rights, no management rights, but as the company increases in value, there are periodic cash-based payments based on the increase in the value of the company. A profits interest in an LLC, by the way, is very similar to a phantom stock arrangement, except that a profits interest is actual equity. Cash payment on change in control. This is not equity at all. This is simply a contract where Mo, Larry, and Curly can agree to give Shemp 10% of the net proceeds of a merger, acquisitions, change in control down the road. If it happens. Now, of course, it may never happen. And until it happens, Shemp has no actual equity in the corporation at any time. He has no right to vote. He doesn't get the right to participate in management. And frankly, it may never happen. If the company never gets bought out or sold to somebody else, then it doesn't happen. Okay, let's move on a little bit because I want to try to get through in time to do at least a few questions and answers. We don't have a lot of questions here, but that's okay. I'm sure you have some. Let's talk about friends and family offerings. The key to friends and family offerings: never treat your friends and family like friends and family. Always get proper legal documentation, the same as you would if it were me investing in your company, because friends and family think that are doing this because they say they love you, there may be the temptation not to get proper documentation, and that's a problem because people change. Aunt Irma, who wants to give you $10,000 to start your company, and she really thinks about it as a gift, she gives you the $10,000, but all of a sudden she dies, and her estate attorney comes after you and says, well, wait a minute, that $10,000 wasn't a gift. Prove to me that it was a gift. Show me, a deed of gift or a bequest where she said that you had this was a gift. Because an estate attorney, if he's the administrator of the estate, he cannot assume that it was a gift. He has to treat it as either an investment or a loan. And that's where you're going to have problems. I actually have had situations where that has happened, where a client had a friend or a family member who gave the money, the person died, and then it became an issue later on as to whether it was actually a gift or not. If someone is actually giving you some money to start your company and does not expect a return, get it in writing. And if it's more than $11,000, you have to watch out for federal and state gift taxes. Make sure you get the same investor documentation that you would. Let's just talk briefly about angels and venture capital. I could easily do another program about this. Angels are wealthy individuals. Rule number one about angels: don't look to them to provide $1 million or more. Most people who play this game are only looking to make investments of $100,000, $250,000, maybe $500,000. But you're not going to get them to provide $2 or $3 million in capital. For that, you're looking at venture capitalists. Beware, some angels have hidden agendas. They may have a reason for investing in you that go beyond just getting an economic return. Don't be surprised, for example, if someone puts $250,000 into your company, and a few months later they knock on your door and say, hey, by the way, we've got this, my younger son just graduated college. He's got a degree in gender studies. He really is having trouble, finding work. Do you have a place in the company where you can maybe, put him where he can't do much damage? If this person is your lead investor and has put $250,000 of capital into your company, you may have to agree to something like that to keep him or her happy. Be careful. Sometimes angels are we call them dark angels. These are people who have hidden agendas. If you're looking to bring a celebrity on board, be very careful. Celebrities want public relations. They want PR. And that's what they want. They want to be seen as promoting entrepreneurs and all this kind of stuff. So sometimes angels have hidden agendas. Find out what they are before you take them on board. Also keep in mind that if you have a fast-growing tech company that's going to need $3 to $5 million in capital during the first year, this person may not be able to step up to the plate for future rounds of capital. There are a lot of people out there who can invest $100,000 in a company who cannot invest $1 million. Venture capitalists are professional investors. They are the people who put $1 to $5 million into early-stage companies. These are the people you read about all the time in your Wall Street Journal. The rule here, there are two things you have to know about venture capitalists. Number one, these are not long-term investors. These are not people who are looking to build a legacy company for your children and grandchildren. You may want that, but they don't. If they're putting their money in, they want to get their money back in 3 to 5 years, sometimes up to 7 years. and they want to see you have a strategy to get to that exit in 3, 5, 7 years. So you got to be careful here. These are not long-term investors. Sooner or later, they're going to lose patience. They're going to be banging on your door, screaming for their money back. And then the golden rule, and this is true of any investor, by the way, but it's especially true of venture capitalists. This is not the normal golden rule, do unto others as you would have others do unto you. This is quite a different golden rule. He who has the gold makes the rules. If you have a venture capitalist investing in your company, he or she is going to tell you how to run your company, and you better listen. Because that person really at that point, even though they don't legally own your company, if they're not happy, ain't nobody happy. Let's just talk for a minute about initial public offerings. If any of you are in the position of preparing for an IPO, please call me. I would love to hear from you. I don't assume that most of you are at that stage yet. From my mouth to God's ears, may you always, all of you, get to the point where you have an IPO. This is the holy grail of entrepreneurship. It's a complicated process. You have to register your shares with the SEC and state securities legislatures in about half the states. You must prepare a prospectus, which is like a detailed business plan. Give it to all your prospective investors. There are alternatives. You can do private placements to what are called accredited investors. These are high net worth individuals. And then there is a new option, which I actually have done a separate program for SCORE about. It's called crowdfunding. This was just authorized by the SEC last year. But you can now actually issue shares to people you don't know on crowdfunding portals and actually issue shares to mobs of people, 5,000 people who will collectively own 10 to 15% of your company. It's a brand new thing. In fact, I wrote a whole book about it. It's called the Crowdfunding Handbook, and it's available wherever books are sold. I went a little bit over. I apologize. I had a lot of information, but hopefully between the two different parts, some of you probably picked it up on the first part. Some of you picked it up on the second part. But you now have a picture of what the capital raising process is all about. And I'm now available, and I will go over for 5 minutes and take a few questions if you have them. So I'm not seeing any questions now, so let me begin by answering a question that I know you all have, which is, where do I find angel investors? Where do I look for these people? By definition, they're not organized. There's no club of angels. Well, that's not strictly speaking true. I can't just go online, type in angel investors, and get in lists of all the angels that are available in my community. The Internet's not that good yet. But there are some ways that there are some places you can start. In most parts of the country, there are angel clubs or angel forums, they're sometimes called. If you go online and you type in the name of your state followed by angel club or angel group or angel forum, you probably will get one or two hits to groups of angels that meet monthly. They listen to presentations from investors, and sometimes they actually make investments on a regular basis. Another good trick, by the way, if you have a college or university in your area with a business school, find out who the professor of entrepreneurship is. It's a good little trick. Because in my experience, a lot of these business schools now, thanks to the popularity of Shark Tank, which was based on my Money Hunt show, I have to say that. It wasn't based on it, actually. It's just a successor to in a great tradition, let's just put it that way. But due to the popularity of Shark Tank, a lot of these business schools have business plan competitions, and they're always looking for judges, and a lot of these judges are local angel investors. The professor probably knows who a lot of these people are locally who invest in businesses. And another way, a lot of angels don't even know that they are angels. If you have good industry contacts and people in your industry that you might be able to head them up for money. The best angels, in my experience, are not just people who put in money. These are not people who just put in money. They're also people who can help you build the business. To use an old-fashioned term, you don't want just their money. You want their Rolodex, too, their list of contacts, their Outlook contacts. Who do they know? If you have an investor putting in $100,000, that's terrific. But if you have an investor who not only has put in $100,000, but can help you find a distributor for your product, or can help you find a joint venture partner with really deep pockets who can help you get the app up and running a lot quicker, that is worth its weight in gold. There's a famous old saying, if you If you give a person a fish, you feed him for one day. If you teach a person how to fish, you feed them for a lifetime. And that is what you're looking for from your angels. Look for people who are more or less partners in the venture, who can help you build the business as well as give you a little bit of startup capital. That's my best advice for dealing with angels. We have a couple of questions. Number one, do either of these books cover the sweat equity question? The short answer is no. I haven't written a book on that yet. Although if you search online for Section 409A Internal Revenue Code, you will see a lot of law firms have written articles about this problem and how it goes. Go back and look at the slides. I kind of glossed over them very quickly, but I did give you the answers to how to deal with a sweat equity situation when they come up. Whenever you have a sweat equity person coming in, unless they're coming in at the very beginning when the company has zero value, you're going to have this 409A problem, and you got to figure out a way to manage it. It's not a problem for you. It's not a problem for the company, but it's a big, big problem for the sweat equity investor. And what happens is these are usually young kids. They don't know about tax issues. They're not even thinking about taxes. They come on board. They figure, hey, I got 10% of the company. I didn't put any cash. All I got to do is build this app. And then a year later, their accountant tells them that they owe all this money, and that's when they freak out. And they yell and scream, wait a minute, why did you do this to me? I got this big tax problem. Why did you do this to me? Didn't you know about it? And you're going to have to do something about it now because this is your key app developer. This guy can turn it off and shut you down. So you got to watch out for this. Whenever you're bringing on sweat equity players, get a good tax person involved in this. Next question, what would you suggest the best loans for startup without any personal capital? Well, if you're going to be getting loans from like banks, or there's this company, some of you are familiar with it, called Kabbage. It's spelled KABBAGE.com. They do very small loans to startup businesses, but it's always based on some asset or other. If you don't have money of your own to put in the business, well, then you got to have some collateral for the bank. So, for example, if you do an SBA loan, they're going to want a second mortgage on your house. If you're dealing with Kabbage, they're going to want to lean on your accounts receivable. There's got to be something that they can use to repay themselves if the company goes under. That's the problem with outside loans. And there are some people out there. I mean, there are companies that specialize. There are micro-lending programs. For example, the SBA actually has one. Your score counselor is probably the best place to find out about that, actually, that will make very small loans to startup companies. But it's always based on something. It's always based on some kind of collateral. If you don't have money, then you got to have collateral. And if you don't have money and you don't have collateral, what you need is a financial partner. You're going to have to get in bed with a deep pocket person who's more than an angel investor. This is the person who's going to be financing the entire first 12 to 18 months of operation of your business. They're probably going to want 50 to 60% of the company, and you're going to end up working for him or her. That is just the reality. It's the golden rule. He who has the gold makes the rules. So that's basically what I have to say. We've run a few minutes over. I apologize. I had a lot of stuff. But I'm going to turn the floor back to Steve, who's going to talk a little bit more about SCORE and how they can help you raise capital for your startup business. Steve?
Cliff, great job, and thanks very much for that. I just wanted to add one thing, and I've already mentioned it, I guess, before, is that we do have these webinars, 2 each month, on the first Tuesday and the third Tuesday, and the next one we're going to have is going to be optimizing your website and maximizing lead generation and sales, which will be 2 weeks from today. And you'll be getting a marketing or a brochure on that online. Actually, Cliff, I'm looking at this, and I don't know whether you got to Warren's question or not. And do you see that one down there?
Yeah, the short answer is yes. Can I use merchant financing available to me as a down payment to obtain bank financing to pursue a similar? I'm not sure I understand it. It sounds to me like, well, merchant financing, the short answer is, when you talk about merchant financing, what I'm thinking about is something like Kabbage, which is accounts receivable or asset-based financing to help you get through and then give you a bank loan later on when you grow a little bit. The short answer is yes. I mean, you can definitely get the money anywhere you can. If you're using a merchant financing source, however, keep in mind that when you do get to the point where you do a real bank loan, either a commercial loan or an SBA loan, they're going to want you to take that previous line of financing out. They're going to want that paid down. A bank does not want to be a subordinate lender. They want to be the first in line if anything goes wrong to get their money out. And if anybody's ahead of them, they're going to want that loan subordinated to them. You know, if you are dealing with a merchant financing company, make sure that they are willing to subordinate to a bank loan if and when the time comes. Or if they are not willing to do that, then make sure you can just pay off the preceding. It's like paying off a prior mortgage. If you've ever refinanced your house, you know, the second bank doesn't want the first bank around. They want to take out the first bank so that they can be your first mortgage lender. It's exactly the same situation with a small business.
All right, Cliff, that's great, and that's all the time we have for today. And thanks for everybody for attending. I know that this has been a lot of information, and in fact, if I look at some of the comments, everybody has been asking me, is this going to be available? And yes, as I indicated in the introduction, the audio and the slides will be available later today if you go to fairfieldcounty.score.org, fairfieldcounty.score.org. So, Cliff, thanks very much for presenting today. As usual, very, very good job and very complete. Everybody on the line, thank you very much for attending. Fill out your evaluation forms, if you would, please, and please join us in 2 weeks and every 2 weeks subsequently. Thank you very much, and have a very nice day. Bye-bye.